Welcome to Ask Sloan, everybody, and welcome to the new set.
Welcome to the studio.
Uh, so I'm Sloan,
I'm Ben.
and today we're going to be talking about tax-free wealth. How exciting!
What everybody likes to hear about, right? How to save money and keep more of your own money.
Don't you love all the TikTok videos that say you can make millions of dollars and never pay a dime in tax?
Exactly. All you need to do is put it under one LLC and then you'll be
Apparently,
fine.
apparently that's how that works.
But Sloan, you're gonna tell us how to actually save money on your taxes, right?
Well, I'm going to do my best, Ben. That's
Okay.
for sure. What questions do you have to start off with?
Well, let's start from the perspective of a small business owner first. So if I'm a newly found small business owner, what's the first things that I should be looking for in order to save money on my taxes on my first year?
That is an excellent question. Okay. And it's a very important one. And we've covered it a little bit in a couple of our previous episodes. So if you haven't watched, please go back and check out our previous episodes.
Absolutely.
But the very first step you need to make as a small business owner, this is your first business. As long as your plans aren't to go public and get a whole bunch of investors and like it's not complicated, like you're just running a little business. As long as that's what you're doing, you need to be an S corporation. Okay. And the reason why is because you're going to save 15.3% on the first $150,000 in income. Okay. And so that's like $22,000, right? And it's unaffordable. Self employment tax is completely and utterly unaffordable for small business owners. So think about that. Okay. 15.3%. So on every $10,000 you make, you're going to pay $1,530 in self employment taxes. That does not include the regular ordinary tax that you're going to have on top of that. So if we just say that that's 20%, okay, and it's not, it's graduated, okay, but we're not gonna get into all those little details. But if it's 20%, that's 2 grand. So now $3,530 for every 10 grand of earnings is going to the IRS.
And is this aside from income tax, federal tax, and state
Self-employment
tax?
tax is is a part of income tax. What you're referring to is ordinary income tax, which is that 20% that I was referencing.
I see. And so, what other tax do you need to be accountable for as the actual owner of your business? Do you need to treat yourself both as an owner that's paying taxes and paying taxes on behalf of your business, and then also as an employee?
So, and that's the whole thing about being an S corp and what you're trying to get around. So, self-employment taxes are essentially payroll taxes. Okay.
Okay.
So when you hire an employee, you're gonna pay them, okay? You pay them $10,000. They're gonna pay out of that $10,000 7.65%, okay, for FICA and Medicare, okay, which is Social Security, Medicare, those programs. Okay. And if you notice on the W-2, it's box number um 4 and box number 6. Okay.
Subtle flex.
Yeah. Right. So so that's 7.65% coming out of as the employee out of your pay. Okay. So you're going to subtract $765 from 10 grand. But the employer, and if you're also the employer, right? That's you, is also got to pay 7.65%. So you add those two together and that's 15.3%. That's payroll taxes. Okay. And so if you're both the employer and the employee, you're paying 15.3%. So let's say you do start an S Corp, but you pay yourself 100 grand as a W-2 employee. Well, you didn't save any money at all
Well,
because you're paying all those payroll taxes. So what you do is you pay yourself a reasonable salary to work inside your business, okay? And that reasonable salary is variable depending on what you're doing in the business, how much time you're spending, things like that. We usually subscribe to around 35 to $50,000 a year,
yeah.
okay, for like office manager, right? And then the rest of the money that you make, you just take as draws, okay? Which is considered a distribution of profit. That profit is your money. It's subject to ordinary income tax, but not payroll tax, not self-employment tax.
So, quick question: would it be in your best interest as as an employer, if you are the only employee for your own business, to not pay yourself, um, a decent amount and actually go lower on the lower
Well,
end?
when you first start your business, you're not gonna have any cash flow. Like it's gonna be really hard to pay yourself. Okay. So
Okay.
so that's why again, it's what's gotta be what's reasonable. So in the first couple of years, like if it's not reasonable, then it's not reasonable. Okay. But if you're taking money out of the business to pay your personal bills, well, then that's going to be considered compensation, right? So it's either compensation as an employee or it's a distribution of profit. And you've got to you basically split that. Again, what's reasonable for you to pay yourself as an employee,
Yeah.
and then the rest of it needs to be profit. That's how you're limiting that self-employment tax and saving money.
So do you think that the same concept is applicable to the guy selling t-shirts out of his garage?
Yeah, absolutely. What if any business you're doing, if it's a side hustle and
Okay.
you're not an S corp,
Yeah.
you're getting hit with self-employment tax. So if you file as a sole proprietor, that goes on a Schedule C, and that's subject to self-employment tax. If you get an LLC and you're the general partner in the LLC and you don't attach an S corporation to it, that's also subject to self-employment tax. So the only way to get around that is through an S corporation. If you start a C corporation, that's a whole nother animal, and that's for professionals. Okay. If you understand business, you have a C corp for a very specific reason, which is more than likely you're going to go public one day. I mean, it's a much more thing. You need to be a mature business person, meaning that you need to like really understand the different structures of a business before you're ready for a C corp. Because in a C corp, you're going to pay yourself a lot more and you're gonna spend a lot more, like, there are a lot more taxes on a C corp.
So, do you think that there's certain limitations to having a C corp if you're not necessarily trying to, make your business IPO at some point or
Well, yeah,
anything
because
like
the
that?
C corp is taxed by itself,
I see.
and you can't take money out of it. If you take money out of it, it's called a dividend, and then that dividend is taxed separately, okay? And so it's double taxation. So it can be even worse than self-employment tax.
Because essentially you're paying more in taxes as a C corp, but then what are the benefits to being a C corp if that's the case for the
So if you're
truth?
gonna go public, the benefits are you pay yourself a small salary and all your value is wrapped up in your stock.
I see.
So this is where tax-free wealth comes in, okay? But it's still not tax-free. Everybody, please hear me. Taxes are not free. Okay. I'll tell you how that works for the people who don't pay tax and why they can do that in just a minute. But the truth of the matter is, let's just take Elon Musk as an example. Okay. It's a very simple example. He
Okay.
does not make a salary. Okay.
Hmm.
Elon Musk does not get paid by Tesla, SpaceX, the Boring Company, Neuralink. He does not get paid, period. Okay. So he doesn't get paid. So he has no taxes on his compensation because he doesn't have any.
So for the people at home, how does Elon Musk make money? As an
Sh-
individual, how does he have money?
Shares of stock.
Okay.
So he owns shares of stock, and those shares of stock have a value. And he borrows money against that stock.
Okay.
And loans, here's your tax-free wealth tip. Loans aren't taxable.
So you don't have to pay the capital gains, and that's how you
Well,
avoid
no, because it's unrealized.
unrealized. Oh,
Unrealized gains. And I know you heard people talking about it because Joe Biden thought we were going to tax unrealized gains.
unrealized capital
That's
gains.
absolutely insane. And we can go into that in another episode.
Yeah, that honestly
But
all makes sense now.
but the situation is such that he has shares of stock. If they have a value that somebody's willing to lend against, then he can go borrow money against those shares and he doesn't pay any tax on the money that he borrowed. Now, one day he'll be required to sell those shares. He'll be required. Okay.
Mm.
Bill Gates had to divest. Jeff Bezos had to divest. Steve Jobs didn't get far enough in the game to divest. Elon Musk has had to divest. Okay. Divest means you sell some of your shares in the stock. You lower your um, personal share
Ownership.
of ownership
Yeah.
of the company. And you get required to do that over time because you stop being a part of the business, so on and so forth. You're not ever required to divest 100% of your stock, but you get down to very small amounts. Okay. 4%, 5%, 6%. But I mean, hey, what's 6% of $1 trillion?
Hmm. Interesting. So, do you think that that's, and I know we could get into it a little bit further down the line, but do you think that that might be one of the main reasons that Elon Musk decided to, vote on Trump's side to be against the unrealized capital
No,
gains?
unrealized capital gain tax would be an insane thing, and I mean, you gotta have an act of Congress, and I mean, I'm not gonna like conjecture on why Elon Musk chose Trump or not, but the truth of the matter is that if governments take a position to tax unrealized gains, they're basically going against their people, and it's just not going to happen. Just like Donald Trump's not going to get rid of the IRS.
Okay. And would unrealized capital gains just be against people that take loans against their investments,
Well, unrealized gains would mean
or would
you
that
would
be
be
just on
taxed. No,
any
all
stock,
you would be taxed on all stock that you had
all stock that
that
gains?
that gained.
Wow.
So
But
then the
what about if
question
that
is, what if
stock
it
drops?
loses?
Yeah.
Exactly. Exactly. So if that stock drops, are you giving me a tax rebate? I get to deduct now? Like it's an insane math problem. It's not
That
happening.
would be insane. Yeah,
It's just
because
not
you would
happening.
have to give everybody a deductible, right?
Yeah.
Against all drop
Up
stock.
against all drop stock.
And then at that point, then you would just what? Not why not just invest in all stocks that you probably think are not going to last?
So now you're rolling all these losses. Like,
And
nah,
you're just making a ton of
it's crazy.
yeah, that'd be
But
awesome.
but but for sure, the concept was let's tax people like Elon Musk who have all this stock. Okay, it's a tax on the billionaires.
Yeah.
Okay, but it ends up hurting the little guy.
Yeah,
So
essentially.
long story short, unless you really know what you're doing, C corp's not for you.
Yeah.
And will that work? Yes, but if you don't have a public market for your stock's not worth anything.
Okay.
Okay.
Now, what are some of the ways that somebody without a small business can save on their taxes?
So the number one thing that people are talking about when they're talking about tax-free wealth is related to real estate.
Okay.
Okay. And what I always tell my people is you're gonna be taxed on the first dollar that you make. Okay. You just are. Okay. And so if you have a W-2 job, they're taking taxes out, you're taxed on that. Okay.
Okay.
You've got to make money to um, get approved for a loan.
Okay.
So if you're going to go buy real estate and you're going to get a loan for that real estate, you've got to have some earnings. Your tax returns got to show that you made money. You're going to pay tax on that first dollar.
Okay.
Okay. Now, like the Grant Cardones and all the people that Rich Dad Poor Dad Kawasaki guy and
Yeah.
and all those guys, what they do is they take the money that they have. Let's say they made $200,000, okay, in wages, okay. Then they're taking that money and they're applying for a loan and they're using that as a down payment. Okay, so they're not buying single family homes. They're buying commercial properties. They're buying multifamily properties. They're
Yeah.
buying $1 million property. They're putting $200,000 as a down payment in that $1 million property.
Okay.
Okay.
So a down payment on the loan from the bank.
Correct. So hey, I want to go buy this $1 million property. I'm putting $200,000 in. Now the question is, how, how how do I pay my mortgage? How do I pay my rent? Oh, wait, what about my telephone bill? Who covers Verizon? I mean, who can put 100% of their earnings into an investment? I mean, I don't know anybody. I mean, I don't
Yeah.
know
I
anybody.
personally cannot
Okay.
do that.
Now, once you're independently wealthy, then okay, great. Then you can do that. But guess what? Grant Cardone doesn't have a job where he makes $200,000 a year. Grant
Interesting.
Cardone is a business owner, right? So let's be fair, right, and reasonable. Okay, but here's how the math works. And the math does work, but it's whether or not that math works for you. Okay. And this type of math doesn't really work for everybody. But if you earn $200,000 and you put that $200,000 into $1 million property,
Yep.
and then you do a cost segregation study and do accelerated depreciation, you pull out 20% of that depreciation in year one. So that's the $200,000. You're able to deduct that depreciation from your taxable income, which is $200,000. So now your taxable income is zero and you don't pay any tax.
So
So,
let's
so that math works, but it's extremely difficult to get into that position. Number one, you have to be able to use all your money for your investment. So somebody else has got to be covering your bills somehow. So the first time you do this, like, I don't know, time number 5, time number 7, time number 10, like, you know what I mean? Like, you got to get to a place where you can do that, where your personal expenses are already covered.
I see. So let's reel it back a little bit for the people at home that may not know what some of these big terms mean, right? So when you said cost segregation study or degradation
Yes.
study?
No, segregation.
Okay, cost
Cost
segregation
segregation
study.
study.
What is a cost segregation study?
So in a building, Okay. And we're in a building right now. In a building, you've got a foundation.
Okay.
Okay. You've got plumbing. You've got electrical. You've got the walls.
Okay.
You've got doors, windows, a roof. Then you've got cabinetry, tile, flooring, carpet. You follow me?
Okay. So you're essentially adding all the costs for what it
So
takes
the
to have the
cost
house.
segregation study is I'm segregating. I'm breaking this building down into its individual parts,
Okay.
and
Itemizing
I'm
essentially.
itemizing it. I am itemizing the building in its separate parts.
Got
I'm
it.
attaching a value to each one of those parts.
Okay.
Okay. So if it's a single family residence, your depreciation is 27 and a half years. If it's commercial property, it's 39 years. So divide a million by 39 years. It's not a lot of money every year.
Yeah.
It's definitely not $200,000. Okay.
Yeah.
So to do the cost segregation study, you're pulling out the tile flooring, the, just all the different things that are considered 5, 10, and 15-year depreciation schedules. And
Yeah.
you're leaving the foundation, the outside structure as like 39 years. Okay. And so that's how you're able to pull out. And then because you're using it's called a 179 deduction. Okay.
Okay.
This is tax code that allows you to take that 5, 10, and 15-year property and take 100% of that deduction this year.
I see.
So Donald Trump changed it back so you can have that 100% deduction this year.
Hmm.
Last year it was 60%. The year before it was 80.
So, quick question regarding your accounting background. Um, Whenever there is, just a new president in office, a new tax bill that's being pushed through, do you have to read through the entirety of the tax bill to know like what different tax codes you can take advantage of?
So that's a great question. All right. The tax code is thousands of pages.
Yeah.
Okay. And I'm gonna be honest with you, I haven't read it.
I
Okay. I haven't read it. And to be perfectly honest with you, probably like at least 600 of those pages don't really apply to most of my clients.
Yeah, I mean,
Okay.
small businesses versus commercial and industrial, probably why,
Just
right?
it just really kind of depends, you know. So
Yeah.
so as an example, the solar tax credit. Okay. Have I read the code on the solar tax credit? Yes. I've got a bunch of clients in the solar game.
I
So I,
see.
I read the code on that. Now they just changed the law. So there's no longer going to be a solar credit.
Yeah.
So it's gone.
Yeah.
So now I don't have to read those pages anymore. What happens is every year they change all the law and then they give you a summary. Okay.
Yeah.
And they say, hey, this is the things that change. So every year, tax professionals, CPAs, they do what's called CPE, okay, or CE, continuing education, okay, CPE, continuing professional education. So you're basically brushing up on the new law, okay, and they tell you what the form is and how that works. And it's all a formula. It's done in a software. Some professionals are reading that particular couple of pages in the code, learning
Mm,
about it. Depends on how complicated it is.
mm.
But generally speaking, you're learning about the code when the code applies to your client.
Okay.
Okay. And this is also why there's a bunch of tax strategists out there that'll tell you, hey, like I'm not a CPA, but I'm a tax strategist. Okay. So what they're doing is they're reading the tax code and they're trying to find ways to help people save money in taxes, but it's a lot less complicated than it sounds.
I see. So within these tax codes, do you think any of that is actually beneficial to, the little guy that doesn't have a business at all?
So going back to like my tips and explanation on how this works,
Yeah.
the only way to spend money on taxes, I mean, the only way to save money on taxes is to spend your money. Okay.
Interesting.
So the $200,000 that I earned,
Yeah.
I spent it on the property. And the tax deduction I'm going to get out of that is depreciation. Now, keep in mind the cost segregation study is going to cost me $5,000. So that's not free. Somebody's got to do that for you. You got to pay the CPA to prepare your taxes. That's probably $1,000 if you've got a cost segregation study in there and you're doing fancy account. I mean, you know what I mean? Like, so like the professional fees cost money too. Like there's a cost to everything, right? Now,
Yeah.
can you write all those things off? Yes, absolutely. I call it a 30, a $1 to 30 cents. Okay. So every dollar I spend, I save 30 cents. Okay. So if I got $3,000 in taxes, how much money do I got to spend?
If you have $3,000 in taxes,
How much money do I got to spend to get rid of that?
$30,000.
$10,000, right? $1 for every 30 cents.
Mm,
So $1, 30 cents. Okay, right? $3 in taxes, $10 in spending.
okay.
Does it make sense?
Yeah.
So there's 70 cents in there. Okay. So if I have $3,000 in taxes, would you rather keep 7 grand or spend 10?
I see what you mean.
Okay. So then the first question you got to ask yourself is, do I need to spend the money? And not everybody that buys an apartment complex wins in that game. I'll tell you right now, the real estate market is terrible. So if you're holding real estate, you're losing money. One of my clients has been sitting on their rental property for 5 months. Who's paying for that? Do they get to write that payment off? The interest, not the principal. And how much is the depreciation? Well, if I took accelerated depreciation last year, I can't take it this year.
So what should they be
So
doing?
there's a ton of like nuance to this. Like this
Yeah.
strategy has got to be long term. It's got to be for your personal situation. It's got to be thinking about the budgets and the costs and all those things. And it's like you have to understand where the money's going and how that's working for you. And it's always a long term strategy, bro. And you're still gonna pay a little bit of money in taxes. You're just probably gonna pay less. So instead of thinking about tax free, think about less tax.
Okay.
And the number one way, in my opinion, to have less taxes is to start a business.
So start a business even though you're not selling anything.
No, like you need to sell stuff,
But
but now you're
what if
in
you have
your
nothing to
business.
say
Most
to
of the
sell?
stuff that I do is business related. So most of the money I'm spending is a write off.
Okay.
Now, if I didn't have the business, it wouldn't be a write off. I may not be spending it though either.
Okay. But what classifies as a write off? Just anything that goes towards your business at all?
Well, technically, anything, any cost that you have associated with your business is a write off. Okay, but if you're under audit, you need to defend that. And the way you defend that is through invoices, bills, receipts,
I see.
and additional documentation like brochures, uh, business and marketing plans, leases,
Yeah.
lease agreements, contracts.
Because I've seen a lot of these different videos on like surfacing the internet about, opening an LLC, buying a vehicle under your LLC, making it a vehicle for your business, quote unquote,
Yeah, and
and
that's
then
so that's
deducting it
that's
from your
true. So
taxes.
that's a great example. Okay, my car is a business write off. Now I personally use mileage because I drive a lot.
Mm,
So mileage is a great write off. It's 68 cents per mile. It's like it's more than 2/3 of what I. So if I drive 10,000 miles, then I get to write off 6,800 bucks.
800 bucks.
Do you know how much my gas costs for that? Like $1,200. The mileage deduction is great, and it's great for small business owners if you drive. If you just commute to the office, that doesn't count.
Really?
Mhm.
Why not?
Commuting is not a write off.
Oh, okay.
It's not considered business mileage.
It needs to be like commuting to a client.
You got to be traveling to a client.
Okay.
You got to be traveling to a meeting. You got to be traveling to the manufacturing plant. You got to be driving for work. Not drive not like logistics. Not You're not a delivery guy. Okay? But you could be a delivery guy. I mean, all you Uber and DoorDash people, you know what I mean? Like,
What about for people that don't own a small business? Like, how do they save money on their taxes when it comes to, spending? How do they spend wisely to save money on their taxes?
well, I mean, that's going to be involved in what the government subsidizes. Okay, so you would want to put a solar system on your house in the last 10 years. It's not going to work for you next year. I'm so sorry, but but you'd want to put a solar system on your house. But then the question is do you want a solar system? Is that going to help you? And the true answer is some people, a solar system is great for them.
Yeah.
They want it. It will help them. At the end of the road, the cost will work, but they're overpriced because you're paying a lot of money to that sales guy. I mean, a lot. Number two, you're borrowing money at a huge interest rate. So I would pay cash and I would ask for a huge discount. Okay. But then you get a 30% credit, tax credit. So if I buy $100,000 solar system, I get a $30,000 tax credit. And that's dollar for dollar against my taxes. But see, I spent $100,000 to
Yeah.
save $30,000 in taxes.
Yeah.
So would you rather keep $70,000 or do you want that solar system?
I guess that's fair.
Okay, so if you don't need the solar system, you don't want the solar system,
And
then
what
don't
is
buy
called
the solar system. Just
Yeah.
pay the tax guy, bro. Just cut him off his cheddar and walk away with $70,000, man. You know what the best money in the world is, y'all? After tax dollars, baby. Come on.
What about like buying art to save money on tax?
No. If you're a W-2 employee, unfortunately, you're subject to your credits. So you're talking about having kids. You're in the past 10 years, you were talking about alternative energy, stuff like that. Okay. It used to be oil and gas. Like they subsidize different markets through tax credits and things like that. So you have to put your money in those subsidies in order for it. But at the end of the day, it's always that thing. Same thing with retirement funds. Okay. Like if you're an employee, the best thing you can do is max out your 401k, especially if they're matching. If your employer's matching, max out your 401k, get your employer to match, and then buy a Roth. The Roth is even better. And that's because when you pull money out of the Roth later, when you're over 65, it's completely tax free because you used after tax dollars to buy it. The 401k is different. It's pre-tax. So I get to save the 30 cents now, but I'm going to pay it later and I'm going to pay it at a higher rate because that's just kind of how that works.
Can you take out a loan against either of those things?
Generally speaking, no. They in times of pandemic and things like that, then they definitely give us some options there for that. But
Usually no.
I recommend not doing that. Don't put money in your 401k that you need. It's never touch it money. It's for retirement. If you pull it out, you're gonna get screwed. 40 to 50% of that's
40 to 50% is taxed.
gone. They say, oh, it's only a 10% penalty, but really you're taxed on it, number one. And then there's a 10% penalty on top of that. So like it's just terrible. But we're running out of time on this one.
Yeah.
Let me leave you guys with a couple of tips. Okay. So again, we'll just reiterate. First time business owners, S corporation is the way to go. Pay yourself a small salary and make money. Okay.
Yeah.
Like if you make money, then you got taxes and you can save on that. Number two, loans are tax free. Okay. So if you understand how to buy assets and to take loans against them, then those loans are tax free. It is a whole game. It's a game you can play. It's a legal game that you can play. So that's definitely something to consider. But the most important thing is don't spend money if you don't need to spend money. Keep that 70 cents and start building wealth. And the way you do that is a 50-30-20 plan. Live on 50% of what you make, save 30% for taxes, and save 20% for long-term savings. If you can get that right, then you'll be building wealth starting today.
You heard it here first, folks. Tune in next time and have a great week.
Thanks so much.